Greetings, Dr. Jeffrey Scott here. This is my weekend market update for October 29, 2023. Email address hdsidoc@gmail.com. If you're new to my channel, please click subscribe, hit the alarm, and you'll be notified when I place these. Thanks to those that signed up over the last week to get me to 1,000. I do this as more as a hobby and passion, not as a business. So I don't do any marketing or sales, but it was kind of nice to see that 1,000 get hit. I titled today Markets Break Support, Fed on Deck. I could have put things like, are we oversold enough? Is a bounce on its way? Because I think those answers are also very possible. For those that are new, I spend the first 20 minutes or so talking about market direction, looking at various different tools I use for breadth, and then I go into wealth charts, which is a great tool for sifting through the market in a very efficient way to come up with some ideas for trading in the upcoming week. As always, anything I say should be considered education only. I'm not licensed with any Series 7s or whatever that would be necessary for me to give you investment advice. I'm actually a physician, not a broker. I am independent, although I do have some tools in the market. They're small entities, and I'm not affiliated with any major software company. I don't get paid by anybody to say good or bad things about them. And then obviously, trading involves risk, and you alone are solely responsible for any investment decisions you make. I always like to start with what the markets did. So this is just a quick snapshot. It's 5 days in the market, some of the major indices that I look at on a daily basis. So what comes to mind? Well, the first thing is Bitcoin and natural gas had good weeks, up 6%. They are the big winners. Bonds were up 1.4 and gold was up 1.4. So if bonds are starting to move up, that is a change in the market. Now, if we look at in yellow or the major equity indexes, you could see all of them are red, and the biggest negative is minus 2.6 on the Nasdaq and the Nasdaq 100, minus 2.4 on the NYSE, minus 2.5 on the spiders, minus 2.1 on the Dow, and on the Russell minus 2.5. So broad-based weakness. On Friday, the only thing of all of them that was positive was the Nasdaq Composite, and that was up 0.5%. Mostly driven by earnings, especially Amazon, which outperformed. Now, we have lapped the 52-week lows, so now November 3rd is already advanced from the October 13th, which was the actual low on this cycle. But off of the 52 weeks low or date, you could see that we're still up quite a bit in the Qs, and the Nasdaq, the Qs leading. The Russell is pretty much back to where it was a year ago, the weakest of the bunch. This is from Q Edge. The good news is it's an awesome tool. It updates intraday, and it's on one of my screens during the day because it gives me so much information. The bad news is it requires a whole different program, which is a Refinitiv or Metastock real-time data to do that. We'll start up here. You could see on Friday, and this is on the S&P 1500, all 1500 sectors were down, the 11 sectors of the S&P 1500. So nothing was working. 92% of industry groups were down, and 81% of stocks were down. So that was a pretty, as we would say, significant whipping of the market. You'd like to see a major sell-off as we put in a bottom on higher volume, and you did not have higher volume on Friday. Over here, you could see that 17% of the stocks are below the lower Bollinger Band, not a signal. You can be 30 or 40% below the lower Bollinger Band, but you have seen reversals. We could get to that point of 30 or 40% below with a couple of bad days in the market. Looking down here, and I did a educational program on Saturday for owners of my marketplace package, and you could see that over the last month, the sectors have been down, all of them. The S&P 1500, 88% of the stocks in the last month, and 88% of the industries and 82% of the stocks. So as bad as Friday felt, it was sort of indicative of the month as a whole. It's been a difficult month if you are a long only or a long-term investor. This is another Q tool, that's the breadth tool. And what I want to point out here are these pink arrow downs. Years ago, Ian Woodward, affectionately referred to as Woody, came up with an indicator called the bingo. And the bingo is an indicator of the baby out with the bathwater. You start to see those in markets that are getting near the bottom. So the bingos are interesting, and it's something that will make me pay attention. Now, this down here is the 13-week new high, new low, which is just off the bottom, and is certainly in a reversal area. So this put a check mark in the we're getting close to reversal by the 17% or so below the bands, the bingos, and the 13-week new high, new low in significantly oversold area. You can also see here the new high, new lows in the general market are just bottoming here. Um, this is another tool that's on another one of my monitors. This is from Nick Drendel. This is probably the cheapest thing I've ever bought. It's less than 50 bucks. And it's just a great, I mean, I'm sure anybody that's good with Excel can make it themselves, but why bother for 50 bucks? And it shows you the only thing up on Friday was the Qs. You could see everything closed in the bottom of the range, especially small cap growth, the ARCs. If you look at everything is below the 50. The only thing above the 200 is the Qs, and that's barely. By the way, the general NASDAQ is below the 200. And if you look at one-day change led by gold miners, consumer discretionary, internet, Amazon influence right there. On the week, left here is a 10-year, on the right is the 30-year. They both turned down a tad, dropping 1.6% on the 10-year, dropping 1.3 on the 30-year. We got a Fed coming up. The economy is pretty resilient, and actually, I was a little bit surprised to see that the rates actually dropped a little bit this week. But I think little bit's the key. Look at the little nubbin. Is there a recession in our near future? So I guess the hot news here is notice how the 10 minus 2 and the 10 minus 3 yield curve is getting back to zero. It inverts when it goes below that black line. It reinverts when it goes above it. Notice these gray bars are recessions. They occur when we reinvert. Well, we're getting close to reinverting. Does that mean a recession is imminent? Now, why does the 10 minus 2 and 10 minus 3 narrow? And if you when it's below, it means the 2 or the 3 are greater than the 10. So two things would happen. Either the long-term rate gets higher, or the short-term rate gets lower as the Fed cuts because of a recession. I think this is a case of the 10 and 30-year getting higher as the rates higher for longer resonates with the market participants, but it is still something to pay attention to. Now, if we look at credit risk, down the lower left, it's up from the baseline, but it's still not spiking, which is what you'd expect to see if we were going into a recession. And if you look at the Philadelphia Diffusion Index, although it's dropped back below zero, it's still above minus 20. And the recessions have occurred when we've been below minus 20. To be fair, this one did dip below minus 20 before it recovered. So, but two things that say no recession imminent, two things that say be careful. Breadth. Stocks above the 200, stocks above the 40 have continued to drop. This is how low they were in March of 20, and this is March of 20 here. So although we're at areas where we typically start to reverse from, it can get much lower. Here's that 13-week new high, new low in oversold territory. The current buckets here showing 85% of the stocks below the midline, the Bollinger Bands in the S&P 1500. That, my folks, is a weak market, and here's your 17% below, both of which are bearish, but neither of which are bearish enough to say that a reversal is imminent. Hindenburg omens occur at market tops. We certainly are not looking for one. The reason why I show this is look at the new lows and the new lows. Here's on the NASDAQ, here's on the NYSE. Essentially less than 0.5% of new highs and nearly 15% of new lows on the NASDAQ, less than 1% on the NYSE new highs, and over 12% new lows. You don't typically see markets go up when the number of new lows far exceed the number of new highs. Sometimes that's an early signal of recovery when the new highs start to creep up. We're not seeing that yet. That goes against an imminent recovery. Here is a worksheet from EdgeRater where I looked at the prior week's fundamentals and asked the question, are there any groups that are outperforming? Well, we're looking at groups based upon ERG, which is EPS rank plus relative strength plus group rank. We throw out the tails and the head because there's so few stocks. And what you see is, except for an earnings-driven blip here, for the most part, we are just living below 2%. So it was a minus 2% week. That actually matches up well with the indices. And yeah, you were down less if you had good earnings rank and good relative strength rank, but really no pattern there except a weak market. This week, it's important to know what's coming, and we have a lot of things going on. We have nothing on Monday. Thank God for small favors. And then Tuesday, the last day of the month, we got employment costs. We got Case-Shiller. We got confidence. On Wednesday, we got employment, manufacturing PMI, ISM manufacturing. We've got a Fed announcement and press conference. Certainly the market is expecting nothing from a rate hike, but we'll be listening closely to words of pause versus raising next month. Thursday, we got jobless and productivity. And then Friday, we got the monthly unemployment or monthly employment numbers. So a very busy week in news. And oh yeah, we are now starting, we're in the second of the 3 or 4 weeks I call earnings Lollapalooza, where we have a massive number of earnings. And if you look at it, it's hard not to find something you own, whether it's McDonald's, Pfizer, Amgen, AMD, PayPal, Generac. We love Generac down in South Florida. Shopify, Lilly, Apple, Cardinal Health. They bought one of my companies. Starbucks. So there's so many things occurring. So it's a judgment call to hold stocks over earnings dates. It's bad judgment to hold stocks. It's bad judgment to not know when your stock's earnings date is scheduled. So how will we know that the market's reversing? I often talk to my friends about O'Neill follow-through days. This was developed years ago by O'Neill. It occurs when a major index closes significantly. Well, it starts with an attempt to rally. So you have to have a positive day. And then 4 to 7 days after that, you see, typically, could be longer than 7 days, you see a 1% or greater move on higher volume, typically above average volume. And that's called a follow-through day. Typically, we look for them on the NASDAQ and the S&P. Most sustained uptrends will follow a follow-through day. Strong gains, breakouts by top growth stocks typically occur around that time. And historically, they have a great track record of finding new uptrends. However, not every follow-through day works. In fact, we had one on both the S&P 500 and the NASDAQ on October 6th, but it failed. I think it's still a valid tool for reentry, and I'll continue to watch for one as a sign of time to get back in. So tough week for the stocks that I showed you. The S&P is down 10.3% lower than it was a month ago. Broad-based retreat. On the S&P 500, not the 1500, you did have one positive sector, which was utilities. Look at how communications was down 6.3%, energy down 6.2%, mixed earnings, lots of news. Now we got Ford and Stellantis have reached an agreement with the UAW. Concern about the world, whether it's Israel, Ukraine, or even Taiwan. Will the Fed consider pausing with GDP of 4.9%, strong personal income and spending? Finally, we got a speaker in the House. This guy gets a unanimous vote. I think it was called fatigue from all the concerns about not having one. Now we have to think about in November, we've got another budget deadline, and this guy's a hawk when it comes to budget, so it'll be interesting to see what happens. Not being political, you don't know which way I want to go, but I think it's going to be a tough battle. Lots of news ahead, as I pointed out. Markets are in decline. It's hard to catch a falling knife. I step to the sidelines. Now I'll consider small positions long and short um, at any time, but I'm going to have small positions and tight stops. If I get some stability and then a follow through day, I'll get much more interested. You got to be careful. Markets like this will destroy your account. And I don't care if you're pointed long or short, there's risk both ways. And we'll look at that as we go forward. So I just like to remind myself of these two all the time. And it's probably the 40th time I've showed these. On the left from Bank of America Global Research. Market bottoms are these blue lines. Fed rates are the thick line. Notice you don't see a market bottom until the rates come down. The rates have not come down yet. We're talking about pausing the increase. So why would we expect a big bottom? Second thing, this black square represents the average bear market in a normal economy. The red, the average bear market in a recession. If we go into a longer term secular bear instead of just a cyclical bear that we may be in, one could expect much lower lows. Don't want to ruin your day, but I always think it's good to be realistic. Um, let's take a look at the markets. So right here I'm looking at in wealth charts. This is a 5-minute chart of the spiders. So this would have been Friday and this is Monday. So the first thing that happened, a small gap down, and then Monday and Tuesday we traded in a narrow range. And then what happened on Tuesday? Tuesday ended fine, and Wednesday we gapped down, and it was like a slide all the way down into the weekend. So we are in the midst of a 3-day pullback in a otherwise weak market. If we look at the spiders, and this is one of the things that has me nervous, and I apologize, it gets hard with all the markings, but notice this trend line here, which was resistance. This trend line here was support, and you could build one up here for resistance as well. What would have been nice, as we did in October, as we did in March, as we tried to do in the beginning of October when we had that follow-through day, would be to have reversed off of this trend line. We have broken through this trend line. That is bearish significantly. Notice we have taken out. We've taken out the 50 in yellow. The thin little red line here is the 200. We've taken out the 4,200 or 420 on the spider line, which we thought might were resistance become support. And we broke through the anchored VWAP to the late 2021, 22 early highs. That's a weak market. Now, what would be the natural expectation? I think around 403, 404, we're going to get into this area here. And then the next one's probably closer to 380. I think we're likely to bounce within the next 1 to 2% down on the spiders. Added to that, besides what I showed you on the buckets and the 13-week new high, new low, we are getting pretty extended down on the MACD, but we're going to look for it to turn up before we get excited. And the high-low jump is at minus 100. So we're the most extended to the downside that we've been in 200 bars. So it's bad. It's broken through support. It is in an area where we might see a reversal. There's no rule that says that we're not coming back down to the October 2022 lows. And that will be painful because that gets you closer to 350. I am expecting a bounce and a bounce relatively soon. I'm not necessarily saying that we break out because let's say we start bouncing on Monday. Not a promise, not even an expectation. Nothing would make me happier than for us to open up 20 or 30 handles on the spiders down and close higher on the day and be a reversal day like we saw back here in October. Okay. But my expectation is here we could run right up here and then fail. That has to be something that you've got to be concerned about, even if we rally. I mean, we could break through and go back up to the top as well. But my guess is we drift, we rally, and then we'll talk more when we get closer to that. What was support may become resistance line. All right, so that's the spiders. The Qs also broke through trend line. They got the 200 right below, so they're right above support. Again, two indices that I think are within a couple percent of where they might bounce. If we look at the diamonds, and actually before I stop here, if we look at the Q dailies here, you could see they're above their 200. I'm sorry about that. If you look at the weekly on the Qs, let's see, Q dailies above the 200. The NASDAQ is below the 200. So those seven stocks that everybody talks about, the leaders, the large caps, are continuing to hold up this market in many, many ways. It also says that if those big ones break the other way, look out below. If you look at the diamonds, you can see the diamonds are at the bottom, probably actually broke through, at least touched what I think could be support here. So these three are both nearing an area that you'd expect at least a reaction, if not a big bounce. Now the Russell's the worst. The Russell, here is your October lows. Here are your June lows. And we are sort of at a triple bottom on the Russell. So when I pointed to the S&P and said how bad it would be if we go visit our October lows, it would just be like the Russell. Now, the other thing I want to point out to you is that high-low jump is at, let me make sure, we know that we looked at the spider was minus 100. We are minus 83 on the Qs. We are at, you have to trust me because it's not showing here, on the diamonds we're at minus 100. We're also at minus 100 on the Russell. So all these are in areas that you'd expect a reaction, bounce or pause. If we look at volatility, the VIX has come up off of 12s up to the low 20s. If this market really falls down, you could see VIXs popping up to 35 or higher. So this is not that impressive where it's at. On the week, you can see the VIX was up considerably. It was up, actually, is that it? That's the prior week. If we look at the UVXY and we put that on a weekly, that was only up 2.86%. I thought it was up greater. That's interesting. So let's go back here. So the VIX was up 5% on Friday, and on Wednesday it was up 9%. But I guess the Monday it came down quite a bit. That's what mitigated that. The dollar is sort of in the higher part of a trading range. Let's put a rectangle on that so we can watch it going forward. Okay, move this out of the way. Pop this here. All right, so we got a dollar in a bit of a trading range. Let's see if it holds. This was prior area that I was hoping for a stop here with on the way up at resistance. We failed. Dollar strength has been, I think, a negative in this market. Despite the strong dollar, gold was up considerably on Friday. Silver was up as well. Gold is leading silver, probably more because of the risk in the marketplace related to what's going on in the world. Oil stabilized at the 50, was actually up a bit on Friday, 1.9%. Even though natural gas was up on the week, It was not up on Friday. You can see the 10 years on the daily chart was up, was flat on Friday. If you look at the week, the 10-year was down a bit, but keep in mind it was down a bit at a major high. My weekly market timing model, no surprise, is in sells in all the major indices. There's only two components. One's the bongo, which has a number of components in it. The other is price, and both are negative for each of the four major ETFs. If we look at the S&P sectors on the hourly, what I saw was some defensive opportunities. Look at staples, utilities strong, materials shot up here as well. Look at how financials teased us and came down hard. These are relative to the S&P. It doesn't mean anything is positive. It just means within the S&P 11 sectors, they're not all moving the same amount the same way. And then we go into our scanners. Now, in a bull market, I might be spending a lot of time and looking for stocks to buy. Probably not going to happen today. Now, this confused me, and it suggests to me that there must have been some rallies in some of the stocks after hours. But if we remember on Friday, the Qs were up, and so some of the big cap tech were green. In general, the S&P was negative, and you could see a lot of red as well. Whether good or bad, I don't know if it is good or bad. This tool reflects after hours action too, so it can change versus the close. If we look at the wealth scanner, and I'll leave it on this bearish sort to start, what you could see on the wealth scanner is that all the usual things in a bull market are the weakest. 520 is the weakest you can get. You got triple Qs, you got the semiconductors, you got the Russell growth, you got ARC technology, we've got S&P growth, momentum, software, healthcare, technology, Russell, US growth, core S&P, pharmaceuticals, artificial intelligence, discretionary, NASDAQ 100, internets rather. All of them are at minus 520. This is a broad-based weakness in growth. Very broad-based. If we do a bullish sort and we see what comes up to the top, you're going to see it's all contras. The biggest you can get is 850. Short the S&P, short financials, short the Qs, short the Russell, short the Dow, and then you have some gold miners, short ARKK, short the mid caps. Suffice it to say, this is a weak market with no place to hide for the longs. Therefore, participation to the long side in any more than small pilot or special situations would have to be considered dangerous. Now, let's take a look, because there were some longs of interest. So I like pullbacks and uptrends. So I have a scan that says, and I've lowered the price and volume in the current market setting. $3 and 200,000 shares. Bullish dots. At least one, no bearish dots. I've got a cold today, so if you're hearing my sniffles, I apologize. I'm sure you're hearing them loud and clear. I want bongo daily and weekly to be bullish, and I wanted a reversal within the last 9 days on the daily. So when I run against a list of over 1,000 stocks that I call my combo leaders list, in a bull market, we'll see 200 stocks with dots. This is it. We do have some 4-dot players. Remember, the dots are gaps, volume, breakouts, momentum. I found over 20 plus years of trading that there's never really been a big market run or a big stock run that did not start with one of those. So more is better. ATGE is an earnings play. It's an education company. I'll be the first to say I don't know anything about this group. It's a group that I've stayed away from in the past. The wealth charts earnings have not been updated yet. They'll probably be updated over the weekend. Here's a stock that had earnings, upgrades to 55. It's trading less than 50 here. A nice gap up on volume, breakout of momentum. Look at relative strength and OBV. Now, if I go and look at the list, I can tell you that LRN is another stock in the same group. Strider also was up on earnings, a breakout on earnings. Are there any others? Several of these made it to my longer list, but ATGE is one, LRN is another. QB is a regional bank. On the most part, again, I apologize for the noises. I am sinus time of the year, allergies in Florida. Look at this breakout after a prolonged base on massive volume. So you got a gap, volume, breakout momentum coming out of a squeeze with relative strength and OBV. This is Customers Bank Corp. Deckers had great earnings. So the story here is the market sucked, but stocks that had good earnings really outperformed. This was pulling back to the 200 in a breakout. Might be a little bit too far gone. One that I worked up yesterday, Gas, which is a shipper, and I thought that after this move you might see it pull back some before it goes higher, but it's hard to ignore. A big gap, big volume, breakout momentum from a squeeze, relative strength and OBV. It's a small stock. STNG is another in the group, sort of a steady eddy here, also with a nice day on Friday. This group was moving. TNP is another in that group, as is DHT, as is OSG. We used to call these wolf packs. Wolf packs would be a number of stocks in the same industry group working together, moving at the same time. So those are some of the things to the long that I looked like. U.S. Steel's interesting here. You wouldn't think it would be a great play if we're going into a recession, except if we're going to spend more of that infrastructure money. But there's a potential takeout of U.S. Steel out there. And U.S. Steel did have its earnings here, but they're not in the program yet. So there are things that look good to the long. But remember, if you go for a long here, you are buying a long in the setting of a trend that is lower in the major markets. So counter trend trading can be difficult. What about shorts? I have a list I call my weekend bears, which is some of the negative stocks. And let's put that up. And let's not look for buys on it, but let's look at bear retracements in a downtrend. Notice how many more of these we have? So Axos Finances, what you're going to see here are the opposite of the other side. Here's a stock in a downtrend, a little bit of a retrace into the moving averages, and a breakdown. Many of these have dropped already. Does anybody have a decently high EWZ? I'm looking here at the high-low jump to see something that hasn't fallen already. A lot of these have already fallen. What I'd rather do is short something that looks like this. It's already broken down, traded back up into resistance, and then on high volume broke down again. So you can find similar stocks to pullbacks in an uptrend called retracements and downtrends. But I would rather be looking, frankly, at contra ETFs. So let's look at some of those very quickly. And remember what a contra ETF is. A contra ETF is a stock or an ETF that goes up when the underlying index goes down. So in some of your long-only accounts. So the dog, this goes up when the diamonds go down. Now, this thing's already run a lot. It's at plus 100 on the high jump. It's potentially too far to buy. If the markets pull back, it may give you a better entry. SARK will go up when when ARKK drops, you can see this one's broken out and running. These are the best looking stocks I've shown you. SDS goes up when the S&P 500 breaks down. This had a clean breakout above the 200. SOXS will go up when the semiconductors break down. This is not broken out yet, although it's up off the lows. SQQs will go up when the Qs break down, starting to move. TZA will go up when the IWM breaks down. It's leveraged 3-to-1 out and running. Don't you wish all your stocks look like this? And then you have VIX that will go up when the volatility goes up. This is, to me, a tougher one to play. So let's put this all together. We are looking at a weak market that is broken below support almost everywhere you look. On the surface, that's something that's very bad. However, I also think we are getting very close if we're not already at a reversal zone. So it's difficult to short support. It's difficult to short a very oversold market. So I am not going to be entering many more to the short side. In fact, if we get a hard open down on Monday or Tuesday, I'll use it to cover my contra ETFs. I do expect us to see a bounce in the next days to week. However, just because I expect it, I'm not going to preemptively do trades until I see it. I don't know if that bounce will be anything more than a trade back up to resistance and then we go to lower lows. That's probably the more likely thing that's going to happen unless we get a big surprise by the Fed, an emergency cut. That might actually scare the market. There's a lot of news that could shake this market. I do think we're getting near the lows, so I am more likely going to look for opportunities to the upside, but I'm going to wait until the market tells me that's the right thing to do. If I have to go out and buy things, those shippers look interesting. The education stocks look interesting. Other than that, it's really story stocks around earnings. So let's watch the news. Let's watch the markets. And what we really want to see, in my opinion, even though it might hurt for a few hours during the day, is we want to see another day like we saw in October of 2022. How do we know that this market was done going down? Because we had a open, let's just look at this one candle. On Friday, we closed at 356.50. This is October the 12th. On October 13th, we opened at 349. 7 S&P points, 70 S&P 500 points. 77 SPYs or 70 S&P 500 points. And we closed at 365, 16 points above with a huge bullish engulfing pattern closing at right off the highs, at or off the highs, engulfing the prior 3 bars on great volume. That's how we knew that that was a reversal. That's how we knew the market was going higher. Let's see if we can get one of those again this week. Have an awesome week trading. Be careful. This is not an easy market.